forecasting is a lot like reading a weather radar. The barometer drops and the clouds roll in and you kind of just brace for rain.
Right.
But today the radar is, it's just pure static. We are looking at a geopolitical and macroeconomic landscape that is completely chaotic right now. So welcome to Market Recap. I'm Daniel.
And I'm Air.
Let's set the baseline for today. So this is Monday, August 24th, 2026. On the surface, the S&P 500 finished essentially flat today. It closed at 7,652.86. The tech-heavy NASDAQ was, highly volatile, but it closed slightly down with futures settling at 29,101.
Yeah.
Meanwhile, gold staged this spectacular intraday rally. It surged past $4,700 an ounce.
Yeah.
And while that was happening, U.S. crude oil, WTI, it unexpectedly slipped to $84.94.
Which is just a massive divergence.
Yeah.
We have equities basically pretending everything is normal while hard assets are screaming that the sky is falling.
Exactly. And the mission of today's deep dive is to unpack this market because it's caught between these massive cross currents.
Right.
We're tracking a looming 50% tariff threat on Canada, sweeping new secondary sanctions on Iran, and an alleged administrative push to force U.S. Treasury yields significantly higher.
There's just a lot to digest.
There really is.
Yeah.
And just a quick reminder before we dive into the actual mechanics of all this show is strictly for market context and discussion only. It is not personal investment advice or a recommendation.
Yeah, the goal here is to just help you understand the baseline the market is operating against. So you can see the logic behind these really massive asset swings.
Right. So that brings us to our first core question. Session 1. What set the stage before the U.S. session opened today?
Well, the weekend news cycle was just relentless.
Oh, it was brutal.
Yeah, it really started late Friday afternoon on August 21st.
Right.
The U.S.-Canada trade talks just completely collapsed.
Just fell apart.
Exactly. At 4:58 p.m. Eastern Time, so right as traders were logging off for the weekend, the U.S. implemented Section 338 tariffs of 50% on select Canadian goods.
Wow.
And almost immediately, Canada's Prime Minister Mark Carney suspended the talks and vowed to match those tariffs dollar for dollar.
Which is huge because, the mechanism of a dollar for dollar retaliation is what makes this so dangerous, right?
Yeah.
It isn't just some political statement. If the U.S. taxes Canadian aluminum, Canada taxes U.S. agriculture or heavy machinery to inflict the exact same financial pain.
Right, and it instantly paralyzes cross-border contracting because businesses they can no longer calculate their cost of goods sold.
Yeah, they're just flying blind. And as if a trade war with our biggest trading partner wasn't enough to digest over the weekend.
Right.
Literally 1 minute earlier on Friday, so at 4:57 p.m. Eastern Time, U.S. Central Command confirmed a strict maritime blockade against Iran.
Yeah.
They diverted 68 commercial ships and physically disabled 3 of them to enforce this perimeter. We are talking about the physical enforcement of a blockade near the Strait of Hormuz.
The major choke point.
Right, the world's most critical energy choke point.
Yeah.
And the moment you start disabling commercial vessels, maritime insurance premiums just skyrocket, which acts as an immediate inflationary tax on global shipping.
Even if they aren't carrying oil.
Exactly. Regardless of what goods are actually in those containers.
Yeah. So that's Friday, but then the internal domestic policy might be the biggest shock of all.
Oh, yeah. The Monday morning news.
Right. So fast forward to early Monday morning today, August 24th at 4:14 a.m. Eastern Time. Reports emerged detailing a plan from Treasury Secretary Scott Bessent. It's this aggressive administrative plan to purposefully push 10-year Treasury yields toward 5% ahead of the midterms.
The tools allegedly under consideration to achieve this 5% target are, they're heavy-handed.
Extreme. They're talking about larger Treasury buybacks funded directly by the general account, massively increasing short-term debt issuance, and potentially eliminating the 20-year bond altogether.
Wow. Just wiping it out.
Right. By killing the 20-year bond, you basically force all that long-term borrowing demand into the 10-year and 30-year space.
All right.
Which artificially manipulates the term premium.
But wait, I have to push back here. How can the Treasury possibly micromanage a $40 trillion ocean of debt?
Oh, okay.
It's like trying to cool down an entire swimming pool by throwing in a single bucket of ice. Sure, you're changing the temperature technically, but is it enough for the bond market to actually feel a chill?
I get that.
It just sounds like political theater that bond vigilantes are going to see right through and price out of existence.
The scale of the national debt is massive, yes. But the Treasury is the House, and the House sets the rules of the casino.
Okay, fair point.
Even just the threat of altering the duration of the debt they issue forces primary dealers to adjust their models. It brings up the concept of rate-sensitive bond proxies as yield surge casualties.
Okay, meaning like if you're holding utility stocks or, I don't know, real estate investment trusts for their 4% dividend.
Exactly.
And the Treasury successfully manufactures a risk-free 5% yield on government bonds, investors will just dump those stocks immediately.
Right. They act like bonds, so they bleed like bonds when yields spike.
Got it.
The mere leak of this 5% plan forces portfolio managers to preemptively sell those rate-sensitive sectors.
Yeah, they don't want to get caught holding the bag. So we came into Monday with a collapsed North American trade deal, a kinetic maritime blockade in the Middle East, and a leaked plan to weaponize the U.S. yield curve.
A total powder keg.
Literally. And that is the powder keg that set up the morning. So when we come back, we'll look at how these simmering weekend tensions exploded into explicit market drivers during Monday's trading hours.
Okay, so moving on. Section 2. So what actually moved markets during U.S. trading hours today?
Well, the escalation didn't pause for the opening bell, that's for sure. At 8:19 a.m. Eastern Time this morning, Trump escalated the Canadian situation even further.
Oh, yeah.
He threatened blanket 50% tariffs on all Canadian cars, trucks, automotive parts, and steel by January 1st, 2027, unless production physically moves into the United States.
And the retaliation from north of the border was just unprecedented. Ontario Premier Doug Ford explicitly threatened to cut electricity exports to the U.S.
Right, which is wild.
If you are a listener wondering why a regional power dispute matters to your 401k, consider this. Ontario exports massive amounts of baseline power to manufacturing hubs in Michigan and New York.
Yeah.
If you cut that power in late August, assembly lines stop.
Right.
It perfectly encapsulates the idea of tariffs and supply shocks as multi-channel margin taxes.
Because it ceases to be a simple tax on a steel beam, right?
Right. Exactly. It becomes a tax on the electricity required to run the factory, the logistics to move the product, and the insurance to cover the risk.
Wow.
The entire integrated North American supply chain gets slapped with margin compression simultaneously.
And while traders were, trying to price in a blackout in Detroit, the Treasury Department just dropped another anvil.
Right, the sanctions.
Yeah, at 8:33 a.m. Eastern Time, followed by a detailed 1 p.m. Eastern press conference, Secretary Bessent announced sweeping secondary sanctions. These target Iran's digital assets, technology, gold, aviation, and shipping sectors.
And the critical phrase Bessent used was a zero leakage approach.
Zero leakage.
Yes. He explicitly warned that a major global financial institution is expected to be sanctioned this very week for failing to cut ties with Iran.
Wow.
We really need to unpack how a secondary sanction functions because it is the nuclear option of financial warfare.
Yeah, walk me through the mechanics of that.
So a primary sanction means U.S. companies cannot do business with Iran.
Right. Simple enough.
A secondary sanction tells the rest of the world you can do business with Iran or you can do business in U.S. dollars, but you cannot do both.
Wow. Oh, I see.
If a major foreign bank is caught processing an Iranian transaction, they are instantly cut off from the dollar clearing system.
And for a global bank, losing access to the U.S. dollar is effectively a death sentence.
Completely. It paralyzes their ability to settle international trades.
But let me throw a different lens on this, though. We tend to react to these headlines, shutting off electricity, isolating global banks like they are sudden, unpredictable natural disasters.
Right.
But are they? Or are we just looking at geopolitical escalation as game theory brinkmanship?
That's a good point.
I mean, threatening a 50% auto tariff 3 years from now in 2027, or threatening to sanction a major bank this week, it feels like a maximum pressure negotiating tactic designed to force immediate concessions rather than an unalterable path to economic destruction.
And that game theoretic lens is exactly likely why the S&P 500 didn't crater by 5% today.
Right.
Institutional algorithms and human traders are assigning a high probability that a deal gets negotiated before the 2027 tariff deadline kicks in.
They're calling the bluff, basically.
They are discounting the rhetoric and pricing in a negotiated settlement.
Which perfectly explains the oil paradox we saw today.
Yeah.
This is the anomaly that really stands out. We have Central Command confirming the Hormuz blockade. Over the weekend, Ukrainian drone strikes successfully shut down Russia's Perm oil refinery. You have the physical supply of energy threatened on two massive global fronts. And yet, U.S. crude oil fell today.
Right.
It settled at $84.94.
Right.
So how does crude sell off amidst a blockade?
It comes down to distinguishing between headline risk and the actual physical flow of molecules.
Okay.
The fundamental bearishness overrode the headlines because, according to shipping executives today, transit through the Strait of Hormuz proceeded very quietly over the weekend.
Oh, really?
Yes. Under 20 vessels passed, which is historically low, but they did pass.
So it's not totally shut down.
No, the physical supply hasn't been completely choked off yet.
So the market is essentially calling the geopolitical bluff.
Exactly.
Until the physical barrels actually stop loading onto tankers, traders are focusing on weaker global manufacturing data, which points to a drop in energy demand.
Precisely. Extreme policy threats dominated the television screens today, but the energy and equity markets looked at the actual physical data and called the bluff.
Right. Well, coming up next, we'll dive into the corporate events recap and look at what's on deck for the rest of the week. All right, session 3. What is our corporate events recap and what should we watch next? Because the narrative today was completely dominated by the Nvidia paradox.
Yes. Late Sunday night, around 7 p.m. Eastern Time, an incredible flurry of major Nvidia deals crossed the wire.
It was a massive drop.
We are talking about licensing talks with Perplexity at a $30 billion valuation, a massive strategic investment in Lancium to build 15-gigawatt AI factories, SpaceX AI adopting the Vera CPU, and Elon Musk officially confirming that the next-generation Vera Rubin NVL-72 goes to orbit in Q4 of next year.
So that is a fortress of positive forward-looking fundamental news.
Right, a fortress of good news. And yet Nvidia's stock slid today for a 7th consecutive day.
A 7th day.
Yes. To understand why you have to look back at a quieter piece of news from Saturday afternoon.
Oh, I know what you're talking about.
Yeah, at 2:55 p.m. Eastern on August 22nd, Nvidia quietly notified its enterprise clients of a 15% price hike for early 2027 systems.
Wow, 15%.
Citing rising memory costs.
And this is where we run into the limits of AI CapEx as a self-referential valuation loop.
Exactly.
Because the ecosystem requires tech giants to spend hundreds of billions on capital expenditures, mostly buying Nvidia chips. That boosts Nvidia's valuation, which in turn justifies the tech giants spending even more to keep up in the AI arms race.
Right.
But that loop requires stable hardware costs and cheap capital.
Yeah, if you're a retail investor wondering why your tech-heavy portfolio is bleeding despite all these flashy SpaceX deals, it's about the return on invested capital.
Okay, break that down.
If the hardware to build an AI model suddenly costs 15% more, the software companies have to charge their customers more to make a profit.
Right.
But consumers aren't going to pay $100 a month for a chatbot.
No way.
So the hyperscalers' profit margins get crushed. The market sees that 15% price hike and realizes the spending spree might hit a brick wall.
Okay, but we did get some positive validation on the software side to counterbalance that fear, right?
We did. At 9 a.m. Eastern today, Verizon announced they are adopting Google Gemini and the full Google Cloud AI stack across their entire enterprise.
Which is a major monetization milestone for Alphabet.
Yeah, it really is.
It proves that outside of the Silicon Valley bubble, traditional legacy telecom giants are actually willing to pay for these generative AI models to optimize their daily workflows.
It is strong validation. But the regulatory costs for the tech sector are climbing in tandem with those hardware costs.
Oh, right, the DHS thing.
Yeah. At 8:53 a.m. Eastern today, the Department of Homeland Security proposed permanently implementing a $100,000 H-1B visa fee surcharge.
$100,000?
Yeah.
Think about the mechanics of that. If a tech giant brings in 1,000 specialized engineers a year, that is an immediate $100 million tax straight to the bottom line.
Yep.
It's a massive injection of margin pressure straight into the veins of the tech sector. It destroys startup runways and compresses mega cap profits.
Yeah, when you combine 6-figure visa fees, 15% ship price hikes, and a targeted 5% treasury yield, making capital more expensive.
It's brutal.
The structural costs for technology companies are just compounding from every direction.
Right. Well, folks, as the closing bell rings on a rather bruising session, look on the bright side. If we do end up in a full-blown trade war with Canada, At least your frozen stock portfolios will fit right in with the Great White North.
Yes.
And to our tech investors watching Nvidia slide for a 7th straight day, just think of it as a highly sophisticated AI-optimized discount.
There you go.
If all else fails, we can always trade our tech shares for some of today's soaring gold and use it to buy a lifetime supply of maple syrup before the tariffs kick in.
Yeah.
Hang in there, keep your assets diversified, and let's hope the bulls find their compass tomorrow.
So looking ahead to tomorrow, the calendar is packed with data that will really test these narratives.
What are we watching?
Tuesday morning at 8:30 a.m. Eastern Time, we get the Philadelphia Fed non-manufacturing survey, which will give us a real-time read on services demand and inflation pressures. Then at 9 a.m. Eastern, the S&P CoreLogic Case-Shiller Home Price Index drops.
All right, well, the critical window for me is 10 a.m. Eastern Time.
Oh, yeah. A lot happens then.
We have a huge cluster of releases. Conference Board, August, Consumer Confidence, July, New Home Sales, and the Richmond Fed Manufacturing Survey. That is a highly concentrated dose of growth and risk sentiment catalyst hitting the tape all at once.
We also have a massive test of the Treasury's 5% yield plan.
Oh, the auction.
Right at 1 p.m. Eastern, there is a $69 billion 2-year Treasury note auction.
Wow.
The market is going to watch the bid-to-cover ratio like a hawk to see if there is actual front-end demand to absorb this debt or if buyers are going on strike.
Right.
And throughout the session, we just have to stay alert for unscheduled Iran sanction details, physical shipping updates from Hormuz, and any further U.S.-Canada retaliation headlines.
Well, before we move to our final segment here, is a provocative thought to leave you with. If a looming 50% tariff on our biggest trading partner, explicit secondary sanctions targeting major global banks, and a stated government goal to forcibly push yields to 5% didn't manage to tank the S&P 500 today,
Right.
what exactly is this market pricing in as the worst-case scenario?
It's a great question.
It seems like it would take an actual black swan to break this market's complacency.